Most people spend their entire lives working hard, paying into Social Security, and dreaming about the day they finally retire. They do the math in their heads. They imagine what that monthly check is going to look like. And then the day comes. That first deposit hits their bank account, and something feels off. It is smaller than expected, sometimes just a little, sometimes by hundreds of dollars. And the worst part? Nobody told them why. If you are already receiving Social Security or if you are getting close to claiming, this video could be one of the most important things you watch this year. Because right now, millions of American seniors are collecting less than they are actually owed, and most of them have no idea it is happening. Some of these losses can be recovered, some can be fixed with a single phone call, but others? They become permanent the moment you wait too long. Today, we are going to walk through every major reason your check might be lower than it should be. We are going to show you exactly where to look, what to verify, and what steps to take. Stay with us. This could be worth thousands of dollars to you. Let us start at the beginning, because to understand why your check might be smaller than you expected, you first have to understand how Social Security actually decides what to pay you. And the honest truth is, most people, even people who have been collecting for years, were never fully told how this works. Your Social Security benefit is not a random number. It is calculated from your earnings history. Specifically, the Social Security Administration looks at your highest 35 years of earnings over your entire working life. They take those numbers, adjust them for inflation, average them out, and run them through a formula to arrive at what is called your primary insurance amount, the base number that determines your monthly check. Now here is where things start to get important. Every single year that goes into that formula matters. If 1 year is missing, or if 1 year shows the wrong amount, that error quietly reduces your average. A lower average means a lower benefit, and a lower benefit paid month after month, year after year for the rest of your life can add up to an enormous amount of money lost. This is not a rare problem. It happens more than most people realize. And the first story I want to share with you is proof of that. Margaret was 68 years old and had been retired for 3 years when her daughter convinced her to sit down and look at her Social Security statement online. Margaret was a practical woman. She had worked as a school administrator for 32 years, raised 2 kids mostly on her own, and never missed a paycheck. She figured her Social Security record was probably fine. When she pulled up her earnings history on the SSA website, she started reading through the numbers year by year. Most of it looked right, but then she got to a stretch of years in the early 90s. 2 years showed almost nothing. 1 year showed zero. Margaret remembered those years clearly. She had been working full-time. She had the W-2 forms in a filing cabinet in her garage. She dug them out. Sure enough, her employer at the time, a small private company that had since gone out of business, had apparently failed to properly report her earnings to the Social Security Administration. Because of those missing years, her 35-year average had been pulled down. Her benefit was lower than it should have been, not by a little, but by over $140 a month. That is more than $1,600 a year. Over the years she had already been collecting, she had already lost thousands. The good news? Margaret was able to file a correction. She submitted Form SSA 7008, included copies of her W-2s from those years, and eventually had her record updated. Her monthly benefit was recalculated. She also received back pay for the difference. But here's the harder truth. Not everyone is as lucky as Margaret. Some people wait too long. Some people never check at all. And once certain windows close, the ability to recover that money becomes much harder. So let us talk about exactly how to check your own record and what to do if you find something wrong. Go to ssa.gov and sign in to your My Social Security account. If you do not have one, you can create it for free. You will need to verify your identity using your driver's license and Social Security number. Once you are inside, scroll down to the section called Eligibility and Earnings and click on Review Your Full Earnings Record Now. You will see a list of every year you worked, going all the way back to your first job. Next to each year is the amount of Social Security taxed earnings that were reported for you. Your job is to compare those numbers against your own records. Old W-2 forms, old tax returns, pay stubs if you still have them. If you find a year where the number looks too low, or a year that shows zero when you know you were working, do not ignore it. That missing number could be costing you money right now, every single month. The SSA offers a formal correction process. You can call them at 1-800-772-1213. Visit your local Social Security office or submit Form SSA 7008, which is the official request for correction of earnings record. You will need to provide documentation proving what you actually earned that year. A W-2, a signed tax return, or pay stubs are all acceptable. Now, there is a time limit worth knowing about. In most cases, the SSA prefers that earnings corrections be filed within 3 years, 3 months, and 15 days from the end of the tax year in which the error occurred. That sounds like a long window, but for someone who retired 10 or 20 years after an error happened, that window is already closed. Here is the important thing, though. Even when that standard window has passed, the SSA does sometimes make corrections for certain types of errors, particularly errors that are clearly on the face of the record, or errors caused by employer failures. The point is, do not assume it is too late without actually asking. Many people have had records corrected well after the standard deadline. Now let us move on, because an inaccurate earnings record is just one reason your benefit might be lower than expected. And in some ways, it is not even the most common one. The second major reason is one that millions of people affected themselves, often without fully realizing what they were doing. It comes down to when they decided to claim. The Social Security system is built around something called your full retirement age. For most people retiring today, that age is 66 or 67, depending on the year you were born. If you claim your benefits at exactly your full retirement age, you receive your full calculated benefit, 100% of that primary insurance amount we talked about earlier. But if you claimed early, say at 62 or 63 or 64, your benefit was permanently reduced. The reduction is not small. Claiming at 62 instead of your full retirement age can reduce your monthly benefit by as much as 30%. Think about what that means in real numbers. If your full benefit would have been $1,800 a month, claiming at 62 could have dropped that to around $1,260. That is a difference of over $6,000 a year, every single year for the rest of your life. Now, this is not an error, this is a rule, and claiming early is not always the wrong decision. For some people, it makes complete sense. But what is important is understanding that if your check feels smaller than what you expected, the timing of your claim may be the primary reason. And unlike an earnings record error, this particular reduction cannot be reversed once your window to withdraw has passed. There is one important note here. If you claimed within the last 12 months, the SSA does allow you to withdraw your original claim, repay everything you received, and refile at a higher age. This is a rarely known option that some people in certain situations can use, but it requires repaying all benefits received, so it is not right for everyone. If you are in that window and your financial situation has changed, it is worth a conversation with a Social Security expert. Now let us talk about something that surprises many people because they never saw it coming. Robert was 65 years old and had been on Medicare for 1 year when he retired and started collecting Social Security. He had done his research. He knew his estimated benefit was around $2,000 a month. But when his first check came, it was considerably smaller. He called his daughter in a panic. Something had to be wrong. It was not wrong, exactly. It was something most retirees do not account for until the first check hits. Medicare Part B premiums are automatically deducted directly from your Social Security payment. In 2026, the standard Medicare Part B premium is $202.90 per month, up from $185 in 2025. That is almost $18 more per month, and it comes straight off the top before your payment is deposited. For Robert, the premium deduction was the main culprit. Once he understood what was happening, he felt better, but it reinforced something important. The benefit estimate you see on your Social Security statement does not account for Medicare deductions. The number on paper and the number in your bank account are not the same number, and it goes beyond just the standard Part B premium. If you have a higher income, you may also be paying something called IRMAA, the Income-Related Monthly Adjustment Amount. This is an additional surcharge on Medicare Part B and Part D that applies if your income was above certain thresholds 2 years ago. For many people, this comes as a complete shock. The SSA does not warn you ahead of time with a phone call. The adjustment simply appears as a deduction. If you believe your income has dropped significantly since the year used to calculate your IRMAA due to retirement, loss of a spouse, or other life events, you can appeal using Form SSA 44. Many people successfully have their IRMAA reduced or eliminated by going through this process. Let us keep going because we are getting to some of the more surprising reasons that benefits shrink, reasons that some people have never heard of before. There is a provision in Social Security called the Windfall Elimination Provision, or WEP, and there is another called the Government Pension Offset, or GPO. These two rules have significantly reduced the Social Security benefits of millions of Americans, particularly teachers, firefighters, police officers, and other public employees who worked in positions that did not pay into Social Security. If you spent part of your career in a job that was covered by a government pension instead of Social Security, and then also worked other jobs that did pay into Social Security, the WEP could reduce the Social Security benefit you earned from those other jobs. The formula used to calculate your benefit treats your earnings differently, resulting in a lower monthly payment than most people would expect. The GPO goes even further for surviving spouses. If you receive a government pension from work not covered by Social Security, the GPO can reduce and in some cases completely eliminate any spousal or survivor Social Security benefits you might otherwise receive. These are not errors. These are deliberate provisions in the law. But they are also widely misunderstood, and many people only discover them after they have already retired and are already receiving less than they planned for. If this applies to your career background, understanding these provisions is essential, and speaking with a Social Security specialist before you claim could save you from unpleasant surprises. Now let us talk about taxes, because this is another area where retirees are often blindsided. Many people assume that because they already paid taxes while working, their Social Security in retirement is tax-free. That is not always true. Depending on your total income in retirement, including Social Security benefits, withdrawals from retirement accounts, pension payments, and investment income, up to 85% of your Social Security benefit can be subject to federal income tax. This does not mean you lose 85%. It means up to 85% of your benefit is counted as taxable income and taxed at whatever your normal income tax rate is. But if you are having federal taxes withheld directly from your Social Security payment, that withholding will reduce your monthly check. There is some good news on this front as of recently. A new $6,000 per person deduction for taxpayers aged 65 and older was introduced for tax years 2025 through 2028. According to analysis by the White House Council of Economic Advisors, this change means only about 12% of seniors will owe federal income tax on their Social Security benefits, a significant drop from previous years. If you were previously having taxes withheld and your situation has changed, it may be worth reviewing your withholding status with a tax professional. Let us pause here for a moment because there is something even more fundamental that we have not fully addressed yet, and it connects all of these threads together. The single most powerful thing you can do right now, whether you are already collecting or still planning, is to understand your own benefit from the inside out. Not just the estimate, not just the number on the letter, but the actual calculation, the actual earnings record, and the actual deductions that affect what lands in your account each month. This is where Dorothy's story becomes important. Dorothy was 72 years old when her husband passed away. She had been receiving her own Social Security retirement benefit for 7 years. After his passing, she learned she might be entitled to survivor benefits based on his record, which was higher than hers. What Dorothy did not know was that when you are eligible for both your own retirement benefit and a survivor benefit, you do not receive both in full. The SSA pays the higher of the two, not both combined. Dorothy's survivor benefit was higher, so her own benefit stopped and she began receiving his, which was about $400 more per month. But here's what she also discovered through her Social Security office visit. Because of a combination of her husband's work history and a gap in how survivor benefits are calculated for those who claimed retirement early, she was receiving somewhat less than the maximum survivor benefit she might have been entitled to had they planned differently years ago. Dorothy could not undo the past decisions, but she could make sure she was receiving everything she was entitled to going forward. And the Social Security specialist she worked with confirmed her payment was correct given the circumstances, which brought her peace of mind even when the numbers were not what she had hoped. This is the thing about Social Security. There is no going back to change a decision made years ago, but there is almost always something you can do right now to make sure you are not losing money you are entitled to today. So let us build your action plan, because everything we have talked about so far points toward the same set of practical steps. The first thing to do is review your earnings record on the SSA website. Sign in to ssa.gov, navigate to your earnings history, and compare what is there against your own records. Look for missing years. Look for years where the number seems too low. If you find something that does not look right, do not wait. The second thing is to understand exactly why your payment is the amount it is. Call the Social Security Administration, visit your local office, or ask a qualified financial advisor who specializes in Social Security to walk through your benefit calculation with you. Make sure you understand what deductions are being taken, whether Medicare premiums are included, whether any offsets apply, and whether any withholding is reducing your deposit. The third thing, and this applies especially to anyone who has had a major life change like retirement, a spouse's death, or a significant income drop, is to check whether any adjustments need to be made. Whether that means filing an IRMAA appeal, requesting a correction to your earnings record, or reviewing your tax withholding status, there is often something actionable available. The fourth thing is to make sure you are claiming every benefit you are entitled to: spousal benefits, survivor benefits, benefits you may have suspended, benefits based on a former spouse's record if you were married for at least 10 years. The Social Security system has many provisions that go unclaimed every single year simply because people do not know they exist. And the fifth, perhaps the most important of all, is to not assume that what you are receiving is automatically correct. The SSA processes millions of records. Errors happen. Employers fail to report correctly. Systems have gaps. The responsibility for catching those errors ultimately falls on you, and the only way to catch them is to look. Here's the truth that ties everything we have talked about today together. Social Security was designed to be your foundation, the reliable base that supports your retirement for the rest of your life. But that foundation is only as strong as the information it was built on. And if that information has a crack in it, a missing year here, a wrong amount there, a claiming decision that was made without full understanding, a Medicare deduction that was never explained, the foundation quietly pays you less than you deserve, month after month, without a single warning. The difference between someone who checks their record, asks the right questions, and makes sure everything is correct, and someone who simply accepts whatever arrives in their account can be thousands of dollars a year. Over a retirement that lasts 15 or 20 years, that gap can become truly significant. You have worked your entire life for these benefits. You earned every dollar in that formula. You deserve to receive every dollar you are owed. So here's what I want you to do today. Not next week, today. Go to SSA.gov and look at your earnings record. Check every year. Compare it to what you know. If something looks wrong, write it down and make the call. If you have never fully understood your benefit calculation, pick up the phone and ask someone to walk you through it. If you have had a major life change recently, find out if it affects what you are entitled to receive. Knowledge is not just peace of mind in retirement. It is money. Real, tangible money that either arrives in your account or silently disappears. You now know more than most people ever find out. Use that knowledge. Take the steps. And if this video helped you, please share it with someone you care about. A spouse, a sibling, a friend who is approaching retirement. They may need this information more than they know. Thank you for watching, and take care of yourself. You have earned it.